Got to start with that NVIDIA news, the idea of Chinese regulators and the government cracking down on chip imports of NVIDIA's chips, what that could mean for the broader markets, especially considering the weighting of NVIDIA.
Yeah, I mean, obviously it's not good news. I mean, we saw some of the news about rare earths a couple days ago as well. I think putting the screws to the U.S. a little bit ahead of the next round of negotiations makes a lot of sense. You know, as far as NVIDIA, obviously they've printed amazing quarters, excluding the Chinese market entirely. So I don't think it's a game changer or anything. I don't think the market is all that surprised, you know, that China is trying to build up its own chip industry. But you know, on the whole, a net negative. I just don't think it's the thing that's going to knock this market off this bull run we see.
Okay. But that leads me to your word of the day, which is diversification. So the bull run's really been powered by the AI trade. So then why diversify away?
Well, all I hear is it a bubble? Is it a bubble? Should I own big tech? Should I own gold? Should I own, you know, Japan International? You can own it all. And I think for our wealth management clients in particular, the idea that you have to get caught up in what could inflate into a bubble, I don't think we're there yet by any means. But diversification, right? In this kind of multipolar world, a new paradigm where gold is going up at the same time as growth stocks, you can own a little bit of everything, and you don't have to be overexposed to big tech just because the S&P 500 concentration is at record highs. So own a little bit of alts, own some international. Don't forget about international. Own some precious metals. Own a lot of big tech. Own the growth, but you can own a little bit of everything. And I think that's a narrative that doesn't, you know, it's not as exciting, but it is something that people can do in their portfolios.
Speaking of, your pick for us today is consumer discretionary, a bit of a beaten down sector. I'm looking since the last rate cut by the Fed in September. Consumer discretionary pulling back more than 2%, underperforming by quite a bit of the S&P that's moved higher. Why is this the time to get into consumer discretionary stocks? As we're concerned about the labor market, we're concerned about consumer spending. There might be a potential impact to some electronics makers or electronic sellers in here with the idea of rare earth restrictions. Why is right now the right time?
Well, the sector had been on quite a good tear, so I actually think this is the perfect time to talk about it. A little bit of a pullback to get in. I think the consumer weakness story is overdone. You know, we heard the comments from Delta yesterday. You know, there is a big segment of the consumer that is doing great, that is spending. The labor market is softening in terms of jobs added, but most people are still working. Firings have been low. Wage growth is solid. And I think as we head into 2026, when some of these tax cuts really start to hit the consumer, you're going to continue to see this narrative of consumer spending growth, not weakness. So I think the narrative has missed the boat a little bit, and I think there's still plenty of time to get into consumer stocks. Luxury, retail, auto, rate cuts are still coming, so I think it's a good story.
You know, you're talking about the Delta earnings, by the way. So is there maybe just a kind of a stock pickers lean towards this pick? I mean, when you look at travel and hospitality stocks, they've seemed to do better than some other names as opposed to like a Nike or a Lululemon. So are you saying the sector overall is your pick, or are there certain parts of the sector?
I like the sector overall, but I think you can definitely get granular within it. I mean, it's a very kind of diversified sector, from things like autos and auto suppliers up to luxury retail. So I think you want to look for the companies with good balance sheets that have managed this tariff news well, that might be you know, a little bit prone to outperforming on the idea of rate cuts. Certainly, you've seen home builders and autos do well on that news. So yeah, I think you can get granular in that sector.
Let's go macro very quickly. A lot of reports that we are going to get an inflation report, not when it was scheduled to come out, but maybe later this month. In your mind, does that ease concerns about the Fed, quote unquote, flying blind? Does that take one thing off the wall of worry for Wall Street?
Maybe a little bit, but I think the Fed's moves right now are all about the labor market anyway. So any sort of alternative labor market data, I think, is going to have more of an impact than inflation, unless there's some huge upside surprise that we don't see coming. So I think it's the labor market right now controlling the Fed that's making the Fed cut towards neutral. It's good to have more data. I'll always take more data than less, but I think anything in the labor market is going to be more impactful than inflation here.